right, so let's talk about accident and health insurance. The most of the amounts you receive from from your insurance are going to be excluded from your gross income. So when you go to the hospital and generate a $20,000 hospital bill, but your insurance pays for it all, you don't have to pay tax on that $20,000. Same thing if you get a lump sum payment. Maybe you're in a major event and lose a leg and you get paid $100,000 for that loss of a limb. That's going to be a non-taxable event. But if you receive some sort of payment for lost wages, that is generally taxable. And the most common one we see is Aflac. You see that little duck quacking around town talking about they'll give you money to pay your bills and things like that. Their insurance is designed to reimburse you for lost wages. And in that case, those payments are taxable. And you'll get a form from Aflac telling you how much dollars you got to put on your tax return. Premiums paid by your employer are not income to you. So premiums are a huge expense these days. It is not uncommon to see upwards of $10,000 for an employee's portion of health insurance that's paid by the employer. Luckily, you do not have to pay tax on it, and your employer can deduct these premiums as a business expense. So this is a huge fringe benefit, and luckily it's not taxable to you, and the employer gets a tax break for it. Medical expenses that are not paid by your insurance. So these are out of pockets, and you're probably familiar with insurance. Oftentimes you have to pay the first $500 before insurance kicks in. Well, that $500 would be a tax deduction to you, but there is some significant restrictions about how we deduct that, and we're going to talk about that later on when we get to itemized deductions. Meals and lodging. Now, this is where your employer is providing you with meals or a place to sleep, and that can be excluded if some of the tests are met. It's got to be on the business property. So if you're a doctor and they have a room at the hospital so you can sleep while you're not working in case they need you for an emergency, that would be tax-free. Meals that are furnished to the employees so they're available. The key is so they're available. That can be tax-free to you also. Now, if you're just allowed to eat at the cafeteria for free just because the employer wants to give you a fringe benefit, then that would be taxable. But if you're required to remain on campus or something in case of emergency or for whatever reason, so that you can be dragged away from your lunch and put back into your work, then that's going to be a tax-free event to you. Same thing for utilities. So if they have a little house on their campus or something, that can be tax exempt also. With the utilities are part of it, those are tax exempt expenses also. Cash, that's a big one. The general rule of thumb is no employer can give any employee cash without it being taxable. I see this quite a lot, especially around Christmas time. The employer wants to give cash bonuses to everybody, and they just want to give them, $200 or $300 cash at the Christmas party. But you can't do it that way. You got to run it through payroll. So that's why it's stated here that cash paid in lieu of meals and lodging is not exempt. So if you're required to stay on campus or whatever, and they just give you some money so that you can rent a room that's nearby at a hotel, or they give you money to go buy food at the cafeteria, that is not going to be exempt, and you will have to pay tax on that. Okay, so let's talk about fringe benefits. These are a lot like all the other ones we've been talking about, health insurance and meals and lodging. General rule of thumb, they're all part of gross income unless they're not. So this works a lot like gross income, where everything is gross income unless it's specifically excluded. And in these cases, they've excluded all the good stuff, really. So it's got to be specifically excluded. Like I said, all the good stuff is excluded. And so let's start taking a look at some of the excluded fringe benefits. One of the good ones is the flexible spending accounts, FSAs as they're often called. This is where they've withheld money from your paycheck, and as long as you use it for certain purposes, you don't have to pay tax on it, because they don't include it in box 1 when we were looking at that W-2. Remember I said FSAs are subtracted from box 1. And so they often report it in other boxes, namely box 12 or box 14, to ensure that you're complying with what you're supposed to do. So some of the common FSAs are like for medical expenses. A lot of times you'll get this medical Visa card or whatever that that maintains your FSA amounts, and then you just use that Visa card when you go to the doctor or to the pharmacy, and that's how you spend your money. One of the other good ones is the dependent care benefit. You can have up to $5,000 withheld from your paycheck. So keep in mind, this is your own money for FSAs or for dependent care benefits. This is your money that you have earned by working for this employer, but they've just withheld it from your checks, and now they give it to you as long as you spend it in certain ways, and that makes it tax-free. So here's the same thing, the dependent care benefit, up to $5,000, and as long as you spend it for daycare or for paying somebody to care for your children or dependents, it's tax-free money. So they would subtract $5,000 from your box one of your W-2. Remember, box one is the one that you pay taxes on. So your gross wages could be reduced by $5,000 for the dependent care benefits. Medical care, that's a lot like these FSAs we were talking about. They'll withhold the money and you use it for medical care. Public transportation and parking, if your employer gives you a bus pass or a parking spot, you know, it's not such an issue down here in Denison, but up in New York City, parking is a huge issue. So they provide parking places for the employees. That is an excluded fringe benefit. And group term life insurance, up to $50,000. Now, we're not talking about $50,000 of premiums. We're talking about the premiums to get $50,000 of life insurance. Those are excluded. But once you go over $50,000 of life insurance, then the premiums for the portion that exceeds $50,000 are taxable income. And like I said, it's reported in box 12 with the code C. So if the premium for $50,000 is $100 a year, you won't have to see the $100. You won't pay tax on the $100. But let's say you bump it up to $75,000, and now the premium goes up to $125. Now that difference there, that $25 would show up in your box 12, and you'd have to pay tax on it. Like I said before, it's usually not very much unless you get into some crazy dollar amounts of insurance. And then it's, you know, still just a few $100s. Educational assistance, this is where your employer will pay for you to go to college or to get higher education. That can be excluded up to $5,250. Once they go over $5,250 for your education, then that becomes taxable income. Some other excluded fringe benefits are no additional cost services. And this one makes good sense because this is where it doesn't cost the employer anything else to provide you with this fringe benefit. Some examples are empty seats. I know people who work for airlines are often allowed to travel as much as they want as long as there's an empty seat available. They can just jump on the plane and it's tax-free. Discounts. You don't have to report how much discounts you got for working for that employer as long as we meet a couple of rules here. First one, for services, no more than 20%. So if I offer to do my employees' tax returns for 30% less than what it would normally cost somebody, then they would have to have taxable income on that 10% that's below the 20%. So that's just something to keep in mind. And then goods, if Walmart lets you buy something below their cost, now you have some taxable income. So as long as your discount for services is no more than 20%, and as long as they don't sell you goods below cost, then you don't have to worry about taxable income for these fringe benefits. De minimis, this is the good one, because this is the great, as we call it, the great catch-all. It catches anything that's not covered here. And this is, de minimis just means, I don't know, I don't speak Latin, so I think it means I'd like some more chicken wings, I'm not sure. But it's really just means it's a small amount. So this is where it would just be too hard to track how much it costs to report it to you. So the occasional use of the office telephone to call your children or whatever, you know, that is so rare, it'd be a little cost. So it's de minimis. So we don't have to worry about reporting it. If you use the copier to make a personal copy for yourself, again, you're talking, you know, one page, it's less than a penny to make that copy. So it's a de minimis fringe benefit, and you don't have to pay tax on it. Now, at some point in time, yeah, you might cross that line where it's no longer de minimis, and then you would have to pay tax on it. But again, these are very hard to track. So in reality, nobody tracks all this stuff, and very few people ever pay any taxes on using the office machines for personal use. Tuition reduction for employees of schools. This is a big one. This kind of falls into no additional cost services because another student can just sit in on a class and it doesn't really take up any more for that teacher to teach one extra person. And so they can get a huge discount for that. I know my wife is on the board of directors of a college out in California, and they are entitled to an 80% tuition reduction for their children to go to school there. And so that is a huge tax-free benefit. I mean, 80% of college expenses out in California is a huge number. And so we're really grateful for that one being excluded.